All right, we're going to start with number 2 from the quiz, chapters 5, 6, and 7 from summer 2013 for folks at home. Okay. The allowance for doubtful accounts, bad debt expense problem, I could either ask for the journal entries or I could ask for balances in the accounts like I did here. Don't worry about it. Just do the journal entry either way. You can compute what the allowance is, right, and what the bad debt expense is. It's not a big deal. Okay, just relax and figure out where you're at, where you want to be. Okay, so it says compute the ending balance in allowance for doubtful accounts and bad debt expense for each of the following independent situations. So we've got accounts receivable with 120,000 in it for all of them. So I might put that down, kind of right in front of me. And then it says credit sales are 600,000. So there might be some cash sales, but we don't care. We've got the credit ones. If I told you if I told you total sales were 800,000, but 200 were for cash, could you figure out 600 must have been on account, and therefore credit sales? So don't worry about that, right? You want only the credit sales, of course, for your allowance, right? You're not going to have bad debts in the cash ones. That's all, okay? And we want the accounts receivable, obviously. So we got 600 in here. So here's where we're at with any of the problems, right? In part A, it says we got a credit balance and allowance for doubtful accounts. Now, what kind of an account is allowance for doubtful accounts, everybody? Contra asset. That is what? An estimate of the amount of the receivables you expect never to collect, right? And when you do a balance sheet, at least that'll be the estimate. Okay? Could that allowance ever end up with a debit balance? Sure. If I write off more than $2,000 at this point, I'll debit allowance for doubtful accounts and credit accounts receivable when I write them off, and I'll end up with a debit balance in there. So it could happen, right? Obviously, we're not going to put that on our financial statement. That's not going to go on the balance sheet. I don't know what a debit would mean in that account, right, on the balance sheet. Okay, but it could happen, mechanically. And then the other account we've got is what? Bad debt expense, right? Uncollectible accounts expense, bad debt expense. Okay? And what would it be right now? As soon as it said nothing, 0. And at the beginning of the year, it would be 0, wouldn't it? So what they've done is they've sold $600,000 worth in the year. Obviously, they collected a whole bunch of that because accounts receivable is only 120, right? So they've recorded sales, they've recorded cash receipts, they've recorded bad debts, write-offs. What would be a write-off again for bad debts? Debit what and credit what to write them off? That's providing for that. Debit the allowance for doubtful accounts. Yeah, so a write-off would look like this. Absolutely. I'm debiting the allowance for doubtful accounts. So I'd be debiting this account. They've already done that last year, right, during the year. And I'd be crediting accounts receivable because I'm giving up, right, guys? So I take it out of the receivable and take it out of the allowance. Remember that? And then to provide for bad debts in the first place, what did I do in the prior year? That'd be the write-off. What would the provision look like? And we're going to do that again here. What would the provision look like in prior years? Debit what? I'm providing for bad debts. I'm setting up my allowance in the first place. Doing the provision for bad debts. Debit bad debt expense, right? That's when we get the bad debt expense. And credit what? Setting up the allowance at the same time. Allowance for doubtful accounts. Okay, so that's where that balance in the first place came from in the contra account. So maybe last year they put 10,000 in, and then they wrote off 8, and they end up with 2. You got the idea? This is what's left over a number of years, of course. Okay, year after year after year. Remember, you close the revenue expense accounts. You do not close the balance sheet accounts, right? The accounts receivable and allowance for doubtful accounts stays there going forward. Everybody good with that? Okay. All right. So here we go. It says credit balance of 2008. Uncollectibles are estimated at 2% of sales. What are we estimating? Okay, look. The allowance we said is the estimate of the portion of the accounts receivable we expect never to collect, right? By definition, that's what it is. I'm going to show accounts receivable less allowance for doubtful accounts on my balance sheet, and that is the difference is going to be net realizable receivables. Right, everybody? Okay. What's bad debt expense represent? The portion of the goes in the income statement as an expense with the sales. That's the portion of the sales I'm never going to collect. Does everybody see the relationship between these numbers? Right? They go together, don't they? They're totally different things. Got to have that down. So when they say 2% of credit sales, what's 2% of credit sales? What do I want to, 2% is what? $12,000? What do I want, what account do I want to be 2% of credit sales? Not the allowance, bad debt expense. Why? Sales goes on the income statement, and bad debt expense is the portion of the sales you expect never to get. Did that work? Everybody? I want bad debt expense to be 2% of 600,000, so therefore 12,000. You gotta know that, and then this is easy to do. Okay?
If it was 2% of the accounts receivable, you would want allowance.
Right, yes, you'd be estimating the allowance. Because if you estimated you're never going to get 2% of your accounts receivable, you want the allowance to be 2% of accounts receivable. If you estimate that 2% of your sales are never going to be collected, you want bad debt expense to be 2% of sales. Totally different thing, isn't it? You guys know accounts receivable is what people owe you, sales is what you sold to them. Right? Hopefully you sold them a lot more than they owe you at the end of the year. Otherwise you can get paid. Okay, guys? They're different things, aren't they? So the allowance is what? My estimate of the receivables they're never going to see. Right? I want to tell people how much I think I'm not going to get. That's what I put in my balance sheet. My bad debt expense is my estimate of the sales I'm never going to get. Right? I want to put that on my income statement. It's a cost I incurred to get my sales. I granted credit. I'm going to have bad debts. Why do we make this journal entry to provide for bad debts? Why don't we just wait until we find out they don't pay us? Because we're recording the sales now, the account receivable now. When should I record the bad debt expense? Now, when you have the sale, right? It's an expense incurred to get the sale. Why should I record the allowance right now? Because otherwise I'd be telling people I'm going to collect $120,000 when I don't think that's true. Got it? Is this clicking? And if you understand that, and then you keep these accounts together, this should work good for you. Okay? All right, so what's our entry going to be? I'd like bad debt expense not to be 0. I'd like it to be 12,000. Anybody got an idea what to do? Yeah. So any situation I give you, you don't care. You can do it. So my journal entry for A, if I ask for the journal entry, would be debit bad debt expense, wouldn't it? Be confident, you guys. Get it down really solid, and then be very confident. Okay? Gotta be allowance. You bet. I don't have a choice. I made bad debt expense be what I want it to be, and I'm forced to increase the allowance by that amount. What's the allowance now? 14 after I put the 12. Absolutely. You got it, guys. There it is. Debit bad debt expense credit allowance. You don't have to write down the journal entry if you don't want to. You just use the key accounts. 14,000. Actually, you don't have to write down anything. You get the right answer. I don't care. Okay, so the ending balances are what? 14 for allowance. That's for the first one. Bad debt expense. 12. Boom. We're good, aren't we? Everybody comfortable? Okay. Let's do B. What changes in B? Accounts receivable is still 120, right? What's allowance this time? Debit balance of 3,000. How did it get there? They wrote off 3,000 more last year, right, than they had in the account in the first place. You guys agree with that? The write-offs would be this one. Debit allowance for doubtful accounts. I debit allowance for the doubtful accounts this year by 3,000 more than I had in there. I wrote off 3,000 more than I allowed for. That's all it is. Yes, ma'am.
I have a question. So when you said report bad debt expense when sale occurs, so is that like at the end of the month, or literally right when you
No.
made that?
Well, that's a great question. Just when you do financial statements. If I don't do financial statements, you're gonna like this. If I am not preparing a financial statement, I don't particularly care what the balances are in the accounts. I can do whatever. All I don't want to pass up too much because I have to fix them to do a statement. But you don't have to make adjustments every single day.
Okay.
You make them monthly when you do financial statements typically. That's it. So bad debt expense might be recorded every month, every quarter maybe, if you do statements every 3 months, or annually if you do once a year.
So like when you make that sale, you already kind of know in the back of your mind that it's going to like fall through kind of thing.
Not a particular sale, but in general. I have 100,000 customers. I know that on average 2% of them don't pay me. believe it or not, we're trying to reflect economic reality, we just don't know what it is. They're estimating, right? What do you think is going to happen? Your best judgment. So, you're investing your money in my company, I'm trying to tell you what I'm doing. But that estimate's what we got. I don't know exactly. We won't know exactly until it's all done. It's too late then, right? You can't decide to invest in something after it's done. Nobody's going to take your money now, right? So, it's uncertain. Risk return trade-offs. A lot of times, the more risk there is, the more return there is. Right? Well, part of the risk is not knowing what's going to happen. So, obviously. Okay, cool. All right, good. So this one is got a debit of 3. Does everybody see how it could end up with a debit of 3? Just debit it for more than the beginning balance, which means write off more, right, than the beginning balance. Okay, so this time it's a debit of 3, and they think of uncollectibles are 2.5% of sales, and I think they made sales be the same, right? We didn't change that. Yeah. 600,000. They being me, I wrote all these, I guess. Bad debt expense. What do you think? It's 0. So what do I want? I want bad debt expense to be 2.5% of sales. How much is that? I think I'd like to take it up from 0 to 15,000. Anybody got an idea how to do it? Let's debit it for 15,000. All right. You know what you're doing. Life gets really simple for you. So what's that going to be? Debit, bad debt expense, of course. So notice the journal entry is exactly the same. Don't give me different accounts. It's just a dead giveaway. You don't know much anything, right? Okay, didn't study it. You wouldn't believe the accounts I get. People are debit allowance for doubtful accounts, credit accounts receivable, they recorded bad debt, like this. It's weird stuff. Debit cash, credit accounts receivable. It's going to always be that entry if this is what we're doing, right? If we're doing a write-off, it'd be debit allowance and credit accounts receivable. What are you going to be forced to credit for 15,000? So debits have to be credits. Allowance for doubtful. So now I wanted the balances, though. What's the balance in bad debt expense? Oh, 15. We got that one, don't we? Everybody agree? What's the balance in the allowance this time, though?
Credit balance.
Credit of 12. 3 was to get rid of the debit, and then, the rest of the 15 would make a credit balance. You can do these, can't you? That was B. Okay. Let's try C. Keep doing the same thing. What's it going to be? Okay. What do we have in accounts receivable? Still the 120. Could I make those different numbers? Of course. Who cares, right? Allowance. What do I have?
Credit balance of 2,000.
So I'm back to a credit balance of 2 this time. Okay, fine. Right? Sales was 600, was it still? Okay. Bad debt expense, I guess if they've done nothing, it's nothing. Okay. And now what does it say?
Collectibles are 10% of accounts receivable.
So what's 10% of accounts receivable?
12,000.
12,000. What's 12,000? My estimate of how much I'm never going to collect. Where do I put my estimate of what I'm never going to collect? Allowance for doubtful accounts. If you want it to be a debit or credit, seeing it's a contra account, and it's going to be accounts receivable less that account, credit, of course. So I want this to be 12,000. Now don't add 12 to it. I want it to be 12. Right? So what do? It's 2 now. I want it to be 12. See why I'm an accountant. They pay you well for this, too. Okay, what do you think? And credited for 10. Of course you would. Allowance for doubtful accounts gets credited for 10. And that gives me the balance I want. Okay? So what am I going to have to debit for 10? I'm forced to debit for 10. It's not a bad debt expense. Got it. Because we're replenishing the allowance, and that is also where we record the bad debt expense. So what's the ending balance in bad debt expense, gang? 10,000, of course. What's the ending balance in allowance? See, if we calculated a long time ago, 12. Do you have to write the journal entry? No. Use T account. Okay. Use the journal entry if you want. Do it in your head if you want.
You're going to have us do both on Friday? Like mix it up?
Oh, hi. It's like when you do multiple choice. I always just pick multiple choice questions, you know, that somebody's written. I'll just grab the ones I like, and I don't pay any attention to what the answer is. And sometimes you get 15 or 20 C's in a row, or B's in a row, or something. And people will go back and erase their answers and change them because they know you can't have that many in a row. Yeah, you can. Probabilistically, any combination is okay, right? Conceivably, there could be a test where every answer is A, I guess, right? I wouldn't do it on purpose, but I don't ever change it. So when kids are getting ready for the CPA exam, I'm giving 100 questions on an exam, there'll be strings in there, right? There always are. So they learn not to change it. Yeah. Just put your answer down. Ignore what the order looks like. It's fine. Okay. So, all right. Now this time on D, what do we got? Accounts receivable. 120. Allowance? What's allowance this time?
Is it supposed to be 12? Oh, never mind.
Oh, okay. Allowance is what? A debit of 3, right? This time. Okay. So that's different, of course. Okay. And then they wrote off more than the beginning balance or something. Okay. Sales? 600 grand. Bad debt expense? It doesn't say anything. You would assume they closed it and the account is 0, huh? Okay. So then it says the same thing. Uncollectibles are 10%. Well, fine. What account do you want to be 10% of sales? The allowance, not bad debt expense. We're estimating based on receivables. It's the allowance, right? Yeah. I did not mean to. Uncollectibles are estimated 10% of accounts receivable. I apologize. Did I say sales? Yeah. Of accounts receivable. 10% of accounts receivable. Sorry. Okay. So if I want, what's 10% of accounts receivable? 12. I want the allowance to be 12, but that's going to be a different journal entry now, right, guys? That's because there's only 3 in there, and I want it to be 12, so how much am I going to have to add to it? 15. Got it. So I'm going to credit the allowance for doubtful accounts for 15 this time. And what am I going to have to debit for 15? Bad debt expense. We got it. So when I started doing this in class a few days ago, this looked hard, didn't it?
Yes.
Now it looks like, so what? Keep your thinking straight, right? Keep your thinking straight. Let yourself think. Don't worry about rushing through so much as think about it and then do it quickly, okay? Which one am I looking at? What am I looking at? What's that going to give you for ending balance and allowance, of course? 12, that's what we just adjusted to. What's it going to be in bad debt expense? You just put 15 in there, and of course, that's going to be the ending balance if you started with nothing. By the way, could I give you beginning balances in bad debt expense if you're doing monthly statements? Sure. I'll do that in a later class. Okay? We'll always assume it's once a year. Okay? But I want to do a little bit more with this stuff. Let's say I have the same situation. Oh, no, let's change it a little bit. I'll give you a new problem. I want you guys to do this. Okay. Beginning accounts receivable is $150,000. Beginning allowance for doubtful accounts is $8,000 credit. Okay? Now I want you to do this. One, record state can collect an account for $1,500. 5A, B. Bad debts, estimated as 5% of accounts receivable. And then 5B, so this is an or, right? Be one or the other. So these are two different categories. Bad debts, estimated as as 2% of credit sales. I would like you to write journal entries for all of those. Journal entries for 1 through 5, and do on 5, there's 2 of them, so it's going to be 6 journal entries. Can you do them? And by the way, you can't do 5 until you do 1 through 4. Get the ending balances in 1 through 4 so you can do 5. All right? What's the beginning balance in sales and bad debt expense? What's that?
200,000.
No, sales. Sales and bad debt expense. What's the beginning balance?
Sales would be
Zero. We're starting a year. Okay. Sales and accounts receivable started, or sales and bad debt expense started 0. What's the beginning balance in receivables? 150. Beginning balance in allowance 8,000. Credit. Right? And then I move forward. I do all those things. I bet you can do them. I bet you can. One at a time. One at a time. And then put it in T accounts after you do the entry, right? Post it to your T accounts. Figure out where you're at. You know, the percentage of people coming to review sessions is getting bigger and bigger. There's less people in classes and more people here. Same time. We're skyrocketing. Every semester. By the end, we'll have 5 students left. Everybody will come to every review. I'm kidding. Joking. You'll all still be here. Just do this in all your classes. Work this our conference classes, okay? Got a really nice compliment the other day. Student said that after having these for principals, it changed everything. He's failing all his classes. I like that. Working. Sure. I don't know if he meant as a compliment. He hates me. You can actually do 1 through 4 before you post them if you want, and then post them and add up your balances. That'd be fine. You write the journal entries and then post them in the T account. If you're going to use 4 T accounts, right? Accounts receivable, allowance for doubtful accounts, bad debt expense, and sales. Remember, the bad debts are 5% of receivables or 2% of credit sales. Only the credit sales, not all the sales, right? I do that sometimes. That's what it's fast. Final. Make it a little easier. A little harder, but take a little bit.
What about edit tax laws?
This is, well, it's not an expense, you go to the bottom and say, go back and look at chapter 5, the statement, it shows you where it's on.
So would that keep that, would that take my net income down? But it's not an expense.
It's not an expense at all. That's, yeah, so it has, what is that? Net income, it's income operations, but not however, because it's discontinued operations. So you include that one, then it's not include the cumulative effect.
Okay.
Go back and look at that. Fine. Trying to just make sure you read it, but also you understand that that's right. And I didn't do too much discussion in chapter 5, that's all.
Might have been this one. No, oh, it's not a
Comprehensive income, well, I think they have to show it to. Here, discontinued operations extraordinary. There used to be a table like that that would show it. So, we had because we didn't have any enforcement. You tell what your operating income is, and they show that here. And then down below the line, after net income here, you put discontinued operations, and then top of that, extraordinary items.
Okay.
And then, here's where they are, right? When somewhere it talks about change in accounting principle and prior period adjustments, those go straight to you. So you guys got entries? Not too bad? Ending balances? How about ending do you have any balances in sales, ending balance in bad debt expense, ending balance in accounts receivable, ending balance in allowance? Oh, what's net realizable receivables, by the way? Accounts receivable less the allowance, right? So if I ask for that, you can do it, right? Net realizable means what? Realizable, you're going to get the cash. Recognizes is recorded, right? Realizes you're going to get the cash or pay out the cash, right? Realization of an expense or a revenue. Okay? So net realizable accounts receivable is the accounts receivable less the allowance, right? So you got balances for everything? So let's write the entries. Record sales. What was your first entry? Entry number 1. What was that?
Debit cash. Credit sales money.
200,000.
Any credit or debit accounts receivable.
Yep. And credit.
Sales revenue.
Can you just do two separate entries for that? Do the cash?
You can. In real life, it'd be a lot of interest and interest. It would be every day, right? But you can do two if you want it. Okay, what are we going to want to pick up, though, when we do our bad debt expense as a percent of credit sales? What number?
The percent of credit sales will be the 500.
Yeah, the 500 is credit sales. So that's the one we're going to pick up. Got to be careful about it, of course. You don't want to use the whole 700, do you? Okay? Then let's do the second one. Cash receipts on account. What would that be? Debit.
Cash, credit, accounts receivable.
It may seem really silly to you guys to be learning this and you're thinking, gosh, I'm going to go to work and I'm going to be a manager or I'm going to be a human resource person or I'm going to be a marketing person. You wouldn't believe how valuable it is if you can do this. Oh, man. To the basic level, so you can communicate with financial folks. And the same thing I'd say if you're going to be a finance/accounting, whatever, econ type side of things, you really understand marketing, human resources. I hope you're starting to get a feeling for why that might be valuable. I went to a board meeting yesterday morning for this KCE, and we had bankers, and we had people who work from nonprofits, government employees, and people all kinds of different backgrounds. Guess what? Everybody at that level could talk to each other. They really could talk to each other. Right? A couple of them are CPAs, 3 of us, I guess, are CPAs. No problem talking to the rest of them. They knew what we were talking about. Right? And vice versa. So, yeah. You want to build those skills, everything you want to build. I know it's a real pain. It's nice to just learn how to do something to be done. Lifelong learning, isn't that what Bellarmine always says? That's good, Chris. Yeah, that's one of their slogans. A life worth living and lifelong learning. Okay. Make a living and have a life worth living. Okay, let's write off the accounts. What do you do when you write them off? Yeah. This wasn't on this quiz, but of course it's fair game. It'll be somewhere. Debit allowance for doubtful accounts, because you found some of them that you allowed for, and now you're getting rid of them, right? And credit what? Accounts receivable, because you gave up, so you don't think they're going to pay you. You don't write them and tell them that. You just take them off. Okay? Hope someday maybe they'll pay you. You get surprises. Okay, but then we find out that we shouldn't have written it off because these people sent us money. So we got 1,500 of that 11,000 paid to us, right? What would we do?
Debit cash.
You can debit cash if you want. For 1,500, you credit what?
Allowance.
Put it back in the allowance, because with hindsight, we should never have taken it out, right? So I took it out here and then I put it back in there. Debit cash, credit allowance, right, guys? Or you could debit accounts receivable and credit allowance to reinstate it. And then what? Debit cash and credit accounts receivable. Does everybody in the room see how those two entries go together? Same thing, isn't it? Is that a yes? Say so if not. So I can make them one entry or two, it doesn't make any difference, right? Okay. Starting to see through it a little bit, that's good. All right. What do we have to do 5A and B now? We're going to have to find out what our balances are. Okay, so let's do it. Let's do, what do we need? Accounts receivable. Allowance. And then what?
Credit sales,
Bad debt expense. I guess I should put sales first. Sales. Okay. So let's just post our journal entries. Debit cash, debit accounts receivable. Oh, what did I start with in accounts receivable? I'm sorry. Yeah, we better do that. What did I start with in the allowance? I said it was a credit. What did I start with in bad debt expense, of course? Nothing. Starting here. Sales. Nothing. Okay. So the first entry did what? Debit cash. Well, we won't worry about cash because we don't have to analyze that. Debit cash and debit accounts receivable. So accounts receivable went up by 500, right? And then we credited, that's this one. And then we credited sales for how much? 700, but what do you want to make note of? Yeah, 500,000 are credit sales, right? The rest on account credit sales. The rest are cash sales. So we're going to use the 500,000, even though there's 700 in there. Everybody good? Yeah. Okay. Then what do? We debit cash 450 and credit accounts receivable 450. So now how much accounts receivable do you have? 200 grand. Everybody good? And of course, there'd be lots and lots of transactions to make those out. Thousands of sales, thousands of cash receipts, right? All your customers are buying stuff on me. Okay, and then we decided we're going to give up on 11,000. What would that be? Debit the allowance by 11, but what does that make my balance in the allowance? 3,000 debit. So I'm going to have to adjust from that 3,000, right, up to what I want the balance to be. Everybody good? And then accounts receivable would go down by 11,000. Okay? But then what happened? We got cash, right? So we debit cash for 1,500, credit the allowance for 1,500, right? So how much is my allowance now? No, I have 8,000. Oh, I'm sorry. It is 1,500 debit. 3,000 less 1,500. Come on, Keith. Yeah, you're right. Okay. Now what? What's accounts receivable? See, it was 150, 650, less 450 made 200. We took out 11, right? How much is it now? All right. Everybody good? So, what do I know in 5A? Let's do 5A here. I would like bad debt to be 5% of receivables. What must I be estimating? Everybody formulate an answer to that. Make sure you're right. What am I formulating? I think bad debt, my bad debt estimate is that 5% of receivables are bad. What account are you estimating? The allowance. The allowance, right, goes on the balance sheet with accounts receivable. I'm going to show accounts receivable less the allowance to get net realizable accounts receivable. True, guys? It's going to be just like this. Accounts receivable less the allowance for doubtful accounts is going to be net realizable accounts receivable. Okay? That's what we're doing here. So my accounts receivable are 189,000. Everybody agree? What do you want that allowance to be? 5% of 189, don't you? What's 5% times 189,000? 90,450? No, 9,000. I'm going to say 90 is quite a bit out of 189. I apologize. 9,450? Okay, I want it to be 9,500, right? Round it off. Or maybe I want it to be 10,000. Or maybe I want it to be 9,000. I don't want it to be 9,450. Why? It makes it look like an exact number. It's not. I don't want it to be an exact number. It's an estimate. Make sense? You actually see people's financial statements will have the pennies. What are you doing? You know, you really know who's not going to pay you to the penny? You know who it is? Yeah, anyway, so white yourself up. Okay, anyway, so what do we do here? Let's say it's going to be 9,500.
We get points taken off if we get around.
No, fine. Let's say I want it to be 9,500. That's my estimate. Okay? How do I get it to be 9,500? Credit it for 1,500 to get to zero and another 9,500 to get to a negative 9. Or I'm sorry, to a credit balance 9,500, right? That's 11,000, isn't it? My journal entry would be what? Debit bad debt expense, because it always is, right? So that's A, right? For 11,000, and credit what? Allowance for doubtful accounts. 11,000. And we're good, aren't we? Okay, and then what? What's B going to look like? It's going to be debit bad debt expense and credit allowance. Yeah, same thing with different numbers. Okay, so now this time, what do we want to do? This time we want 2% of credit sales. What's credit sales, everybody? 500,000. What's 2% of it? $10,000, is it? Gee, I think I'll debit bad debt expense for 10 grand. And I'll credit the allowance for 10 grand. Okay? What's the ending balance now? Let's see. The ending balance would be 9,500 in the allowance. And how much was bad debt expense when we did it that way? 11,000, right? On this, using this approach, bad debt expense would be 11,000, and the allowance would be 9,500. You guys agree with that? What would it be if I used this approach? Bad debt would be 10, and where would I be on the allowance? Let's see, I have 1,500 and I credit for 10. What would I have, everybody? 8,500. Ta-da! You could do this, couldn't you? Not bad at all, huh? What would I show on net realizable accounts receivable? I've got accounts receivable of 189, If my ending allowance is 9,500, what's net realizable account receivable? 189 they owe me, less 9,500 I expect never to collect, right? How much is that? What if I use the other approach and I end up with an allowance of, what did I end up with? 8,500. I guess I'd end up with 180,500 for my net realizable. You can do these, can't you? Is everybody on board now? Easy, huh? And that's far harder than when I had the quiz, isn't it? It's like a test question or two. Might put in a couple different questions. All right. Let's play with number 3. Switch gears here. We probably don't have time to do bank reconciliation anyway today, I talked to you. XYZ's ending inventory at 2012 is understated by 3. The ending inventory of 2013 is overstated by 5. Indicate the effect of these errors in the statements. You look at this. We've done a whole bunch of overstated stuff, haven't we? You know what makes this harder, though? Is listen to this carefully. The ending inventory of 1 year is the beginning inventory of the next year. That's what makes this hard. So if you have an error in ending inventory of 1 year, what happens to the beginning inventory of the next year? It has the same error. But what do we do when we're doing cost of goods sold? Let's see, we get beginning inventory plus purchases is available, less ending inventory, right? So in the first year, if ending inventory is over or understated, what's messed up? Ending inventory and cost of goods sold. But then the next year, we're going to add the beginning instead of subtracting the ending. It goes the opposite direction. It corrects itself. You got to remember to roll the ending inventory error into the beginning of the next year. So let's do this. Let's look at it. And this is kind of hard. Makes your head spin for a while, but it's just like anything else. As soon as you understand, it's like, I got it. I see what's going on. It's just that a couple of things are moving on. So how do we do this? We are going to take sales, less cost of goods sold is gross profit, right? Less operating expenses is net income. So if you think about what the relationships are here, when I do cost of goods sold, it's going to be just like this. We'd have sales first, of course, right? And you take away your cost of goods sold to get gross profit, then operating expenses to get net income, operating income. I'm going to have beginning inventory plus my purchases, really less purchase returns and allowances and purchase discounts, plus freight in. Right, guys? You know that. You've read about it, okay? All right. Anyway, so what are we going to have here? Available, less the ending inventory. It's going to give me what? Cost of goods sold. You know what? If cost of goods sold are too high, net income's too low. If cost of goods sold are too low, net income's too high. You guys agree with that? It's an expense. Okay? So let's do the years. Let's do 2012 and 2013. It's going to roll forward, you guys. And this is going to be really kind of easy if you'll write it down and look at it. So if I don't tell you anything's wrong with things, what would you assume? It's okay? Sound reasonable? Okay, ending inventory of 2012 is too low by 3,000. This number is too low by $3,000. Would you guys agree with that? That's what I said. So what could you assume about the beginning inventory? I guess it's okay. You didn't say anything. So this is okay. What would you assume about purchases? We didn't say anything. I guess it's okay. So what would you say about available if we didn't say anything? I guess it's okay. So if you subtract too low a number, what happens to cost of goods sold? Too high. Too high. Overstated by 3,000. If I asked you about cost of goods sold, which is an expense, I did, right? It's too high by 3,000. You guys agree with that? Okay. Let's go for net income. If expenses are too high, net income is too low. So revenues would be what? Nothing's wrong. Okay, so we just said this is okay because of this cost of goods sold mistake, right? My expenses are too high by 3,000. Just like we said, my net income's too low by 3,000. What does that do to retained earnings? Here we go. One of the equity accounts is retained earnings. Contributed capital is fine, right? Okay. Retained earnings, what do we have? Too low by 3,000, right? Too much debit. And expenses closed, the retained earnings made it too low, didn't it? What does that do to equity? It's too low. So net income's understated. Retained earnings the first year is understated. Everybody good? Liabilities? They're okay. Nothing wrong. What must be wrong with assets if equity is too low by 3,000? It's got to be understated by 3,000. How'd that happen? But totally, the inventory is understated. That's it. That's what caused it. The first year is pretty easy, isn't it? We've done this stuff, haven't we? The second year, what do you have to remember to do? The ending inventory of one year is the beginning of the next. A number of times I've told you the obvious. A millisecond after the end of the year is the beginning of the next. How many transactions happen in between? 0. So if my inventory is understated by 3,000 at the end of one year, what is it at the beginning of the next? It's still what? Understated by 3. That's it. So it drives you crazy if you take intermediate, you guys, because we could mess with beginning inventory, ending inventory, purchases, you know, all kinds of stuff could be messed up. And it does happen in real life, of course. Okay, people mess up all kinds of things. So ending inventory, understated by 3,000. Got it? Okay. That was the understatement. It did say understatement, didn't it? I hope. I did all that. Read right. Okay. Well, then what would that do the next year? Let's ignore the next error. Let's say there were no other errors. What would this do? Look what happens. If purchases were okay, what would be wrong with available? If beginning's too low, what's wrong with available? Too low. So if there were no other errors, that would happen. You guys with me? If there was no error here in ending inventory, what would happen to cost of goods sold? Too low, right? You subtracted the right number, and from available is 3,000 too low, you would have too low by 3,000. Look what happened. Those two errors. It corrected itself. Both years are wrong, but it corrected itself. See it? Okay? The errors will roll forward. Self-correcting next year. Not that it's okay to have the error, because obviously you told people your income was too low, and the next year you're telling them it's too high, right? So it's still a mess, but at least it's corrected itself. What's that going to do to net income, of course? Cost of goods sold is too low, and expenses too low, net income is too high, right? So those are going to reverse each other, aren't they? Okay? So the overstatement from last year is corrected with an understatement this year, and then the understatement for net income is corrected with an overstatement for this year. Okay? And what does that do for 2013 then? Revenues would be okay. Everybody agree? Expenses would be understated by 3, we said. Net income, overstated by 3. The understatement and the overstatement add up to nothing, right? Self-corrected. When we close it to retained earnings, we would have too much by 3,000. But too much by 3,000, now pay attention to that. Too little by 3 and then too much by 3. What happens? 0. And what's wrong with inventory if there's no error at the end? This was 2012. At 2013, we would have what? Nothing wrong. Everything self-corrects. It's gone. Okay? But that's not what happened in the problem. It made it harder, didn't it? There's an error at the end, too. Overstated by 5. So let's add that. Okay? What's going to be different, you guys?
The beginning of inventory is going to be understated in 2013.
true at the beginning, right, guys? The overstatement from last time is an understatement this time, which is going to make available too low. You just said it wrong. You got the right idea. But what about the 5,000 in the ending inventory? This is too high by 5,000, right? It's overstated. How big is my mistake going to be? 8? Because I'm too low, and then I'm going to subtract too big a number. 3 plus 5, is it? Yeah. Everybody agreeing with that? Yeah. Understated by 3, and then you subtract 5 too much, and now you're understated by 8. The error's compounded, huh? So this is going to be too low by 8,000. So it's going to correct the 3 error, but it's going to give me another one. Did I go right direction? Overstated. Wait a minute. Overstated by 5. I subtracted too big a number. Yeah. This one was an understatement. No, let's go into that one. I don't think it's 2. What's the deal? I've got 3 that came from correcting last year, right? So I've understated available, that's an understated cost of goods sold. And then I overstate the next year inventory. I'm making inventory too high, cost of goods sold too low, right? So I've got 2 things. I've got a 3,000 understatement of cost of goods sold, and then I'm going to have another 5 for overstating the ending inventory. Remember, you subtract the ending inventory, you add the beginning. It'll drive you crazy, won't it? Okay? So 2 errors. I've got the 3 being corrected from last time, gives me too little cost of goods sold by 3. And then I subtract 5 too much, it's another 5 too little cost of goods sold, so it's understated by 8. What's that going to do to net income, of course? Overstated by 8. By the way, what's going to be wrong with equity when you put the 2 years together? Add them together, right? Retained earnings? What is it? Yeah. Retained earnings is going to be overstated by 5,000. Okay? So here we go. How is that going to work? I'm going to have 8,000 understatement of cost of goods sold. Too low by 8,000. What's that going to do to net income? Too high by 8,000. And then when you close that, overstatement, right? When you close that to retained earnings for 2013, what happens? 8,000 too high. And that is going to give me a net, what? 5,000 too high, which is exactly what we thought we'd get. Okay? Now, how does that work? Liabilities are still okay, right? Retained earnings is too high by 5 in 2013, right? Liabilities are still okay in 2013, right? What must assets be? Too high by 5. Well, that's the inventory. It's just fine. Okay? That do it? Wow. So play with some of those. Okay? How many points they give on that? That's a lot of points for that. Okay? On number 4, this is barely in the chapter, and I must have thought they covered it more in the chapter, or maybe they did in an earlier version of the 2013 quiz. Maybe they took some of it out. I think they used to give an example of what it looks like. What page was that on in the book we just looked at?
236.
Yeah, read 236 real carefully, and it sort of explains it. What the deal is, you guys, is here, let's do this. When I do a financial statement for a company, income statement, I'll put sales less cost of goods sold is what? Gross profit. To get cost of goods sold is beginning inventory plus purchases, right? Less purchase returns and allowances, less purchase discounts, plus freight in, gives me goods available, right? And then I subtract ending inventory and I have what? Cost of goods sold. That's how I get it. Take the cost of goods sold away from sales, you have gross profit. Take away all your operating expenses. What's that? Salary expense, rent expense, general and administrative expenses, marketing expenses, human resource expenses, research and development expenses, all the other expenses in the company that are not cost something called operating income. Okay? So operating expense away from gross profit gives me operating income. Then I might have other things down here. These would be called other or non-operating. And these could be gains from selling assets, right? We'll get to that real soon. Losses from selling assets. Gains are kind of like revenues, except there's no expense with it. Revenues always have expenses together with them, right? You're in the revenues and you incur expenses. A gain would be I sell an asset or refinance debt or something and I just have gain. A loss would be the same thing. I just have loss when I sell an asset. So we'll worry about that. Okay? And then we also might have other revenues and other expenses. And these are kind of like rent revenue, if I'm not a rental company, interest revenue maybe, interest expense maybe. So these are other. And then what that's going to give me is net income before tax, or net income from continuing operations before tax. And you will see this on financial statements. That's why I wanted you to be exposed to it. Okay? Net income from continuing operations before tax. Then what we do is we do tax expense. Now you know what, guys? If you don't have all this non-operating stuff, you would just have tax expense following operating income. Does that make sense? So just companies that have it would do that. But in any event, you do tax expense, and that's going to give me net income from continuing operations. You'll see that on financial statements a lot. Net income from continuing operations. Okay, we already took the tax out. Then, if you happen to have, and they talk about it on that page, be sure and read it. We have discontinued operations. And we'll beat this to death in intermediate. We would show it net of tax, by the way. This would be net of tax. And the reason it has to be net of tax is because the tax is already out up here for everything above there. Okay? So net of tax, discontinued operations. That's when I get rid of a major segment of my business. Okay? And I want to separate it from my operations. That's all that is. And then we have something called an extraordinary item. What extraordinary items are things that are both unusual and infrequent. If they're only one of those two things, unusual and infrequent, they would be in here, right? So if it's only unusual for your business, or it's only infrequent for your business, you'd put it in non-operations. If it's both, we have this strange rule. Only in the U.S. Internationally, they don't allow this. Under International Financial Reporting Standards, only in the U.S. we would show extraordinary items, net of tax. This might be a government takes away my property, right? And I shouldn't have expected it. They're really rare, though. If you invest in Afghanistan right now or in Syria, it would not be an extraordinary item if the government took over your property. You lost your property. If you invest in Canada, and they do, it would be. But the idea, if you build a building down by the river in the floodplain, and you get a flood, that's not extraordinary. If we get a flood up here, if that creek there floods this floor, I think it's an extraordinary item. Got it? They're rare, okay? We're not in a floodplain. Even if the first floor gets flooded here, it's an extraordinary item. This is designed so it's not going to get flooded, right? Downtown's going to be underwater before we get flooded up here, okay? So, yeah. So, anyway, but you know what? Down by U of L, when they get floods, is that an extraordinary item? No! Floods all the time, right? If you build down there, expect it. Right? It's going to happen. So, you just cost doing business. Okay. I always like to say that the restaurants that are on the river side of the flood wall, over on the Indiana side, several of those restaurants are on this side of the flood wall, and they actually have floors that are below the flood wall. What happens if we get a 100-year flood and it goes up to the top of that flood wall? Hopefully the flood wall holds. They're underwater and everybody on the other side is not, right? Is that going to be an extraordinary item for them? No. They built there. What if it goes over the top and floods restaurants right across the street on the other side? That's an extraordinary item, right? They didn't take on that risk. So it's kind of that extreme. It's kind of silly. So, And then guess what? There are some other things that go on the retained earnings statement. So what we could do on retained earnings statement, we would have the beginning, right? Beginning balance. And you might have something called a prior period adjustment. And what this is I made errors in the prior periods. So what would, by the way, if you overstated revenue or understated revenue, overstated expense, understated expense, in other words, your net income's wrong in a year, where do you close all the revenue, expense, gain, loss accounts to? Where do you close them before you start the year? The revenue expense accounts, when you close them, where do they go? You guys read about closing? Look at close, retained earnings, yeah. You close everything to retained earnings. So if there's an error in net income for a year and you close the books, where does the error go? To retained earnings. So you don't go back and redo those prior years. You can't roll the clock back. You ever seen that Superman movie where he turns the Earth back to save Lois Lane? Yeah, an old classic. What's that?
Smallville is a show that came on the CW.
Oh, and they put it on? Okay, yeah. It's really funny. So she dies and everybody's sad and everything. He just flew around back, the world backwards, turned time back. Right? He undid it. She's alive again. Pretty cool, huh? I was sitting in a theater with my son, little Ben, and somebody in the audience actually said, that couldn't happen. Superman can fly, though? Yeah, they're watching Superman, for God's sake. But that couldn't happen. That's not realistic. Okay, whatever. All right. Who knows? That's how we do time travel. Superman goes backwards. Yeah, we all do it together. Okay, anyway, so prior period adjustment is correcting the errors from the prior period. So we can either increase or decrease it. By the way, the retained earnings beginning balance, okay? These would be net of tax. Wow. There's a lot to learn, you guys. And I'm not going to hold you to this much. I had one little problem with one point. Okay, then what else do you put in there? Cumulative effect of change in accounting principle. Because it's as though we had used the new accounting principle all along, but what would have affected prior years we put directly to retained earnings and the rest would go in the current year. Okay, so what? And that would be also net of tax effect. Wow. And then what else would you do in your retained earnings, guys? Add the current year net income or take away its loss, right? And then what else? Subtract dividends. And what would we get? Ending retained earnings. Okay, fine. You're going to do a retained earnings statement. And I will not beat you up on this. I just want you to be exposed to it. So here's the deal. On this problem, what did I need to do to find out what net income was? Add up the expenses subtracted from the revenues. So I add cost of goods sold, selling in general, miscellaneous. What does all that add up to? 830? You guys good? So let's do the little problem. It's a simple problem now when you know that. Impossible probably without it. Let's do my sales. And let's do my expenses. It's before tax, right? What's my sales? 1 million. What are all my expenses before tax? 600, 230, is that right? 830, everybody agree? What's my net income before tax? Well, let's see. I've got a net loss for continuing operations, and then I have a cumulative effect of change in accounting principle. Oh, net loss is after tax. So what I'm going to do is I'm going to do my net income before tax is how much? 170,000. Right, guys? Then I'm going to subtract my tax expense. How much is that going to be? What rate are we? 40%. Could you take 40% of 170? Sure. What's that going to be? 3468, is that right? 4 times 17? Okay, what's my net income before the discontinued operation and extraordinary items? Net income from continuing operations, in other words. 102. All right, you got it? Then what do I have? Discontinued operation. And was that a gain or a loss? Loss. So you know what it was? Here's what they had on the discontinued operation. Net of tax, it's 60,000. How much was it before tax? What's the tax rate, everybody? 40%. 40%. Oh, and this is 60%. So what was the loss? What's the deal? 0.6 into 60? 100,000. Oh, 40% tax on that was 40. See it? So here's what the loss was. Here's a tax benefit, because I put 100,000 loss on my tax return. It saved me 40,000 in taxes. Here's the net loss. I don't expect you to be able to do that yet, but you can see where we're going, can't you? This is valuable to be able to do this stuff, you guys. Okay, that's a loss. So what is their net income? What was the answer to this question? 42,000. Why does it only have 1 point on it? Even if the author were still kind of halfway covering this, would you get there? Maybe. Yeah. A few people do it once in a while. Now you might, huh? Could you do something similar to this? How big a thing? Yeah. What goes where? What goes where? Okay, and why? Cool. All right. Let's do number 5, because 5 is nice and easy. I like 5. You want to think of something else to do the rest of the time. And I didn't cover number 5 at all in class, but you gotta hope I put one of these on. By the way, these are sales discounts and sales returns and allowances in this case, but there are also purchase allowances and purchase return allowances. Okay. By the way, there's different types of discounts too. There's something called a trade discount. These are good things to know. And something called a cash discount. You're going to work in marketing, boy, you want to know this stuff. Okay, what do these mean? And then there's allowances and returns too. Usually we put them in one account. What are those things? That's good to know. Okay, what a trade discount is, you guys, is a price reduction. So, you know, you might have a TV set that has a wholesale price of $1,000. You're going to sell it for $2,500. Okay, TV sets cost that much to do. Okay, really, really nice one. Okay, yeah, no, not really. Okay, but anyway, why would anybody pay that much? Boxes that you find. Use your computer. Anyway, yeah, so $2,500, right? They're going to sell it for the store. But the people who are buying it, right, the stores are going to resell it, they pay $1,000 for it. Okay? So they buy it for $1,000, sell it for $2,500. They don't sell it for anything else. Okay? So 1,000 might be the regular list price, except nobody pays that really. They give you a discount based on what kind of customer you are. If you're Walmart and you're buying thousands of them, you might get a pretty big discount. But anybody who buys thousands of them, like Walmart does, gets the same discount. You can't, it's illegal to give different people different discounts for the same size order, right? But if somebody's a real small store, you know, they're not going to get anywhere near the discount that Walmart does. Walmart might get 60% off. They might pay 40% of $1,000. Got the idea? It's just a price reduction. Okay? A small store might get 20% off instead of 60% off. They're going to pay $800 for it. You wonder why the small stores can't compete with the big ones, right? Well, that's why. Okay? Right? One of the big reasons. Okay? So, what we do is we just record the amount we record the sale. Your debit accounts receivable or debit cash and your credit sales is just a smaller number. Everybody got the idea of a trade discount? So you see a trade discount, it's just a price reduction. You reduced the amount you sold it by. Same thing when you're buying stuff, right? Reduce the purchase price. That's it. Okay? So that's not a big deal. A cash discount is different. A cash discount is what? I get a discount for paying sooner. And people will give you discounts like 1% 10, net 30, or 2% 10, net 30, or 2% 10, net, or 2% 15, net 30, or 1% 10, net 30. What do they mean by this? Yeah. discount or a 2% discount or whatever it is, if you pay within the discount period. So this means 1% if you pay within 10 days, net if you pay in 30. So does anybody pay early? Nope. Time value of money. If I owed you $100,000 and I could wait 9 days to pay you more, how many days will I wait to pay you? 9 days. I'm going to use the money, right? Interest free. Why would I give it to you? I don't have to. It's not due yet. So I will pay you in exactly 10 days to get my discount. If I don't pay you in 10 days, though, will I pay you in 11? Nope, it's too late. I don't get the discount unless I'm trying to steal it from you. If I pay you late, you're going to say, whoa, 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 you don't get the discount, right? Because that's the deal. It's to encourage people to pay early, okay? So what I do is I wouldn't pay until the 30th day, then I'd pay on the 30th day. Get it postmarked on the 30th day. What's 2% going to mean then? You get 2% discount. And it just depends on the industry. And these things can be a lot of money. A lot of money. If you're buying millions of dollars from somebody, 2% of it's a lot of money. I have fired people before on several occasions who were bookkeepers who consistently passed discounts. What do I mean by that? We had a 2% 10 net 30 discount and they would not pay it on time, and we'd have to pay the full amount. It cost us more than their salary on one purchase sometimes. Get it? You always take your purchase discounts. On the sales discounts, what would you think if a customer didn't take their sales discounts? What are the possibilities if somebody doesn't take a discount? They made a mistake. Do people make mistakes? Yes. By the way, I never fired anybody the first time they did that. Like, you talk real seriously about what's costing. Like a few, show them what it's costing. And if it costs us more than your salary, they can't have it. Okay? So, what if your customers don't take the discounts? What are the possibilities? They made a mistake. Okay, once in a while, fine. What if they never take it? What are the two possibilities now? They don't know what they're doing, so I guess you're just waiting for them to go broke if they don't know what they're doing, huh? Or they are broke, and nobody will loan them any money. You want to sell them stuff? No. So another reason that you always take your own discounts, one, you make a lot of money by doing it, right? Save a lot of money. What's the other reason? You don't want people to think you're broke or incompetent. You don't want to be incompetent, right? You don't want to waste money. But you also don't want your vendors, people you're buying things from, to think that you're broke or that you don't know what you're doing, right? What is the interest rate on this? Can you guys compute what the interest rate is? Let's do 2% 10 net 30. We actually had that when I was at Ocean Metro Farms and canned goods. By the way, why do you give them these discounts? To get them to pay in 10 days instead of waiting 30. You got it? What is the probability of having a bad debt if you only sell things on cash? Your terms are cash only. You're not going to have any bad debts. What did you give people 1 day to pay? You're going to have some. 2 days, you're going to have more. 30 days, you're going to have more and more and more. Is that the idea? So why would you do 1% 10 or 2% 10? Because you're going to reduce your bad debt experience, right? It'll entice people to give you the cash. But it's real expensive. What's the interest rate on this? If you pass a discount, think about it from our perspective. If we were to pass, we're running a company. Let's say that we have a $100,000 invoice. How big would our discount be if we take it? 2%, $2,000. How long did it take us to earn that $2,000 if we take it? We pay in 10 days instead of in 30. You could wait for 20 more days, right? So it would have cost us $2,000 for 20 days. Got the idea? What's the interest? What is the interest rate? How many 20-day periods in a year? 20 days in a year. Yeah, okay. 365. Divided by 20, what do you get? 18 1/4 times. the interest rate. 36.5%. I told you I fired some people. Because they couldn't get organized, and couldn't get the bills paid, get them in the computer, get them paid. Put the right due dates in the computer, right? Put the discount terms in the computer, tell the computer when to write the check. The computer writes the check. Put it in wrong. Put in net 30 instead of 2% 10 net 30. You throw away $2,000 on $100,000 for 20 days. 36.5% interest. What would 1% be? There's a lot more that are 1% than 2%. It's half of that. 18.25% interest. What are interest rates right now? Oh, 2%, 3%. Large companies borrow at. What do you think? You want to throw away 18.5? How about if you're deciding whether or not to take the discount yourself? How about if you're deciding whether or not to take it yourself? Should you go to the bank and borrow money so you can pay your discount? Would you be willing to borrow money? How much is the bank going to charge you? How much are they going to charge you for $100,000 for 20 days? At say it was 5%. I don't have very good credit, maybe. That's not real good right now for a business. I'm going to borrow at 5%. That's not horrible, but you're not predicting. Okay? 100,000. I'm borrowing 100,000 at 5% for 20 days. How much is that, you guys? This is really important. What's that? You want to do it from 5,000 divided by 365 times 20? What do you get? What's the amount of interest? That's not very. They're going to charge me $273? Is that what it is? Is that close? Yeah. Okay. They're going to charge me $273 and I'm going to save $2,000. In 20 days, I made $1,727. I think I'm kind of a hero. When I went to work at Ostrom Mushroom Farms, I saved them more by borrowing money and taking our discounts because they were taking none of theirs because they were broke, right? I saved them more than my salary the first year from one decision. What do you think my bonus looked like? Bigger than what you saved? Nah, they didn't give me all of it. Are you kidding me? It was only 50% of my salary. And then they raised my salary 50% because they really didn't want me to leave. That wasn't the only thing I did. And now you guys know how. All you gotta do is take the discounts. Go borrow money. The president company thought I was crazy. 100% shareholder, right? You owned it all. He thought I was crazy. You want me to go to the bank and borrow more money? We're on the ropes. They're worried about us. And this is, I'll do a little analysis showing how much we're going to make off of this. And we are going to pay them more of the debt that we owe them by saving the money, right? This is not worthless stuff, you guys. This is really valuable. So anyway, let's do the journal entries here. Okay. Western Company sold 5,000 of goods to Southern on credit on May 1st. At the time of the sale, Western recorded a debit to accounts receivable and credit to sales of 5,000. Of course they would. Debit accounts receivable 5,000. I could have asked them to do that, of course. It's no big deal. Okay, that's what they did, of course. All right. That is on what date? May 1. Okay? So then what happens, you guys? Terms are 1%, 10 net 30? Okay. Present the entries. Southern paid the balance due on May 10th. So assuming that they paid the whole balance on May 10th. So this is recorded in every case. For A, we're saying they paid the whole thing on May 10th. Did they pay within the 10 days? May 1st to May 10th? Yes. Will they get the discount? Yes. How much will the discount be? $500? Well, 50. Okay, I thought you said 50.
No, I did say 500.
Yeah, okay. Yeah, $50, right? Okay, it's $50. Win $500. Yeah, okay, it's $50, isn't it? Okay? Will you take it? Sure, you're doing this over and over and over. Okay, so how much receivable am I getting rid of? The whole 5,000. I'm paying it all off, right? I'm just only going to give them. They're paying me. How much are they going to give me? They could make a $50 discount. How much are they going to pay me? $4,950. And I expect them to do that. Most of my customers will, right? But I get them to pay me sooner. What's the $50? What do we call it? sales revenue, although some companies do, but I won't reduce sales revenue. I think I want to keep track of it separately in a contra revenue account named sales discounts. That's it. So I'll have sales discounts. I know it's a contra revenue because it's got a what kind of balance? Debit. You know what contra accounts are, don't you? Easy, isn't it? That's it. What would I show on my income statement? 5,000 of sales less a $50 sales discount is net sales of how much? 4,950. Got it? It's easy. Okay? Let's try B. In B it says Southern returned half the goods on May 4th and paid the balance on May 10th. Okay. What do you want to do on May 4th? They returned half of them. Okay, let's talk about the difference. I didn't do that, did I? Back on the earlier one, remember I was going to talk about the difference between returns and allowances? What do you think a return is? The customer returns it to you, right? You actually get the inventory back. Or if you bought something, you return it to them. So there's purchase returns and there's sales returns, huh? Obvious. What's an allowance? You don't get it back, you just give them credit for it, give it allowance. So when I was at Ocean Mushroom Farms, we used to sell product. We deliver it overnight, during the night, to produce houses up in Seattle. And we were in Olympia, and it's about a, I don't know, hour and a half, 2 hour drive, I guess. 2 hour drive. Trucks go up there, deliver, right? And they just set them on their loading dock. And then when they'd open up, they'd open the doors and bring it in. Or if they're already open, obviously they bring it in. So you put all these fresh mushrooms out there, outside. Okay, well, that was fine if they didn't drop them off after they closed for the day. Because they'd have all the produce come in, and it's done everywhere. All the produce comes in at night, and then first thing in the morning it's shipped out to the grocery stores and restaurants and so on, right? That's where all the fresh produce comes from, right? Anyway, if they get there after they close on a weekend, the fresh mushrooms would sit on their dock all weekend long. If it's 90 degrees that day, guess what happens to mushrooms? If it's warm at all, even if it freezes. Freezes, they're gone. They're all water. They're 98% water. If it's hot, they melt through the bottom of the cases. They're in their paper cases, right? And cardboard. They slime, they come out the bottom. Did we want to return this stuff to us? No. Sometimes they would. You'd have somebody actually bring you some. Happened a few times. They were so angry they thought they'd show us what we left on their loading dock. They threw it in the back of a pickup truck and brought it to us. Carried it into our offices. Yeah, so we had truck drivers get fired for that kind of thing, right? Leave it after. Anyway, so that would be a credit instead of a return, huh? So you don't get the inventory back. Makes sense? Because you're never going to collect a sale. There's no sale, right? Okay, that's all. So you got returns and allowances. That ought to stick with a fun story like that. So every once in a while that would happen. Oh God, 3,000 pounds of mushrooms out there on the loading dock, melting out into the street, or the alley behind, right? These places, and they clean up that mess. Yeah. So anyway, running businesses is real interesting, you guys. Sometimes. All right. So anyway, what they did was they returned. What do you want to do? I don't want to reverse the sales because it's like the sales discounts. I want to know how much they cost me. I don't want to reduce the sale, but I do want to reduce the account receivable. They returned half of it, right? It was 5,000. So what are we going to credit accounts receivable for? How about 2,500? Huh? Now they only owe me 2,500. Everybody agree? It was 5,000 less 2,500. What do you want to debit for 2,500? No. Wouldn't that be nice? They're not going to pay me. Trust me, they're not paying me. I could debit sales, same deal, but I don't want to. I want to keep track of how much this cost me. So what account would I use? How about a contra account? Named what? Sales, returns, and allowances. Duh, right? Common sense. So what I'm going to now show on my income statement, sales less sales discounts less sales returns and allowances is my net sales, right? So we accumulate them, keep track of them. Okay, now what, on May 10th, are they still going to get the discount for what they did buy? Of course, May 1st to May 10th, 10 days, isn't it? So if they're going to get the discount, how much? Are you going to give them a $50 discount? No. How much did they buy from you? 2,500. So how much discount are you going to give them? 25. So you're going to credit accounts receivable for the rest of it, 2,500. You are going to give them a $25 discount, and they are going to pay you how much? 2,475. Everybody agree? That's it. Is this just getting to be comments? Oh, by the way, what would that debit be? Sales discounts, of course. So this is pretty easy, isn't it? Do a few of them, right? Look at the chapter. The author shows you how, right? Do a few of them. Okay, so now we got something different. Let's look at C. C says there were no returns, but they waited until May 30th to pay the bill. Actually, they wait till May 31st probably, wouldn't they? May 1st? 30 days? Yeah, they ain't right. May 30th they pay the bill, that's fine. No returns. How much are they going to pay you? Well, how much discount are you giving them? Nothing. 5,000. You got it. Debit cash, 5 grand. And credit what? Yeah. That's it. Just building on what you already know. Okay, well, we got about 23 minutes. You want to do inventory? You want to do another example or do this example? We can crank through this one.
Do the last one.
Do a bank reconciliation?
Yeah.
You want to do the same one or do one from the book? Okay.
Wait, don't do the one, we already did this.
We did this one, yeah.
So let's do the other one.
We could probably find one in the book. I may hit them in between. Would you guys look in the cash chapter, cash receivables chapter, see if you can find a problem that does bank reconciliation? Where they're at? You're right back.
I did that. Yeah. What? No, yeah. We can do that one tonight. There's one, I mean, it's computing outstanding checks and deposits in transit, so pretty much,
Hard part?
I mean, what we were doing on it.
Yeah. Oh, you gotta do bank reconciliation? Yeah, that's good. Problem 6-7, you just got there? Page 318? Good job, Michelle. By the way, we won't get to inventory, which is okay, we did class. Watch the other class. Don't watch the one you went to. It's slightly different, right? That makes sense? Or watch one of the old ones. There's an older one on there. I was probably better last year than this year. So, and, who knows? Might be horrible. Maybe even worse than yours. Yeah. 5. Yeah, just you watch one class. Okay, what page did we say that was on? That's all right. So we're on problem 6, 7. I hope you guys didn't say anything really mean while I was gone. You know, because it's recording one right above your head. So. I hate Richardson, don't you guys? Yeah, so I'll listen to that later. That's it. Yeah, right. You think I've ever listened to one of these? No, I never will either. I can't imagine. I can't believe it. You guys actually listen to this. Sorry. After you know how to do it, you won't. Right? That's how it works. Move on. Something else. Okay, anyway, so here's a problem on page 318, problem 6, 7. Bank statement. That's what the bank sent us. We can see that. Here's our cash account. Did they give us a beginning balance there? No. So what would you have to do? Take the beginning balance, add the debits, and subtract the credits? What do you think? Did you guys do that? You could have done that without me. And then they tell you the outstanding checks and the deposits in transit, but that was from last month, weren't they? From July, and we're doing August now, it says there. No deposits were in transit at the end of July. Okay. So can you do this problem? What do you want me to do? I'll write it down, you guys work it. This doesn't have to look like any particular thing. It's bank reconciliation. What do I want to find out? How much cash I should have in the bank, right? For my general ledger. And I want to make sure the bank and I agree on how much cash I have. So I don't, overdraw my bank account, that kind of thing. So let's do this. Let's do cash. Okay. What was the beginning balance they show here? On our cash account. 16,490, right guys?
Yeah.
Right, you count, right? Yeah. Beginning balance. Then what do? Add all those deposits. Add those up real quick. You guys do that yet? No. So here's my beginning. Here's my deposits. And then we're also going to take the checks out, right? Make sense? My disbursements. It's not just checks. There's also electronic fund transfer there and that kind of stuff. But, disbursements. Are some of you doing the deposits? Somebody who's not using their calculator right now?
I did 43,690. That's what I got.
43,690. Does that sound good?
Is that right? I did it in my head.
Oh wow.
43,890.
That's pretty good in his head. Anybody else get 43,890?
43,890.
All right. That's quite a few for in your head though. All right. And then checks. Did anybody do that yet? Gotta have the checks. And then we'll get the ending, won't we? This is the unadjusted balance, we call it. Right? Unadjusted. Because we haven't adjusted it yet. Is that a clever name for an account you haven't adjusted yet? Unadjusted? I always think it's really amazing what accountants call things. What they are.
23,520.
Yeah, that's what I got.
23,520? And you did that in your head? You want applause? They'd probably clap for you.
Let's stand up.
You gotta stand up, applause, cheer. Okay, 16,490 plus 43,890 less 23,520. That's weird. They didn't write very many checks, did they? Is that really right? Yes. I don't care. Strange bank account, or a strange company. What do you think? Have that much cash come in and so little go out? Oh well. How much is it? I put it somewhere. 16,490 plus 43,890 less 23,520. A number of you got 23,520, right? Okay, good. Our miracle worker up here didn't add this up. You know, here's how it's at.
Now we're just getting smart.
Yeah, okay, so what's that number, guys? 30-something? 36-something? Actually, that's slow.
I got 30.
Okay. If you work faster, we can go home soon. I'll always do that. Under control, though, because if you work too fast, like I try to do, talk too fast, and screw it all up, right? Then you have to take longer. So it's balance, okay? That I'm not good at. That's way too impatient. Okay, so what are we going to do? Yes, sir.
I think beginning got rolled into the one below it. I think the 43.
Oh, for God's sake!
I think 43 was the total.
I'm glad somebody noticed that. I thought that was kind of a big number you guys beginning balance in?
Come on, Joe.
Yeah.
She said it, not me.
All right, 16,490. This is the easy part. Add together 11,700, 4,000, 6,500, 5,200. What were the deposits, everybody? That's hilarious. He was so busy doing it in his head that he did it wrong. Like that. I'm just adding the deposits to the beginning balance and subtracting the checks we wrote, right? You guys aren't tired, are you? Okay, anyway. How much was the deposit?
Deposit was 27,400.
27,400. 27,400 even?
Yeah.
Okay, so 16,490 plus 27,400 less 23,520. Sound better?
Yeah.
I just want the ending balance in the account. How much is it?
20,37.
20,037?
23,73.
23,770. Got it. 23,70. We got it at 370. Is that right? That's not right.
I'm writing this in pen.
That's so right.
Okay, who's got it?
I got 23.
She did too. What'd you get back there?
Original, right?
I refuse to do it. Okay, what about you?
Oh,
You got 2370?
I got 23,770.
I think you need to get your calculator out and calculate it.
Me?
These guys, yeah, because these guys all believe it's perfect.
Going off of what-
Okay, that's a $4,000 increase over it. That's about right. She's sitting back there telling us we're wrong. She doesn't even have her calculator out. Yeah, think about that. I've worked with people like that too. Yeah, I make fun of them too. Okay. Don't tell us what you think. Not, this isn't for you, but if you imagine me sitting in a business meeting with a bunch of bankers, you know, and somebody will say that number doesn't look right. See, it is too right. You don't even have a calculator out, for crying out loud. What do you mean? Do you mean it's not the right number because it's a mistake, or it's not the right number because we can't add and subtract? I mean, it might not be the right balance. Okay. All right, that's fine. You can put the company name at the top of this, bank reconciliation, you know, and the date, which if you were working at a company, you would, because you have a whole bunch of different companies and different dates, of course. But all we really need is balance per bank and balance per books, okay? And this is the unadjusted balance per books, of course. Leave some room for you. So this can look like anything you want it to look like. You'll see different formats. I think this is the way the author does it. Time since I looked at it, so sure. What's the balance per bank? Look at the bank statement. What is it?
The beginning's 17,000.
Yeah, that's the beginning. I don't want that. I'm reconciling at the end. Ah, so I want the August 31st balance.
18,190.
Yeah, there you go. 18,190. There it is. What's the balance per books, you guys? What do we think we have? This is also at August 31st, right? I'm reconciling at the end of the month. 2370. You like that?
Yes.
Excellent. Okay, I want to get the same numbers when I go down the page. Okay? That's all I'm doing. Adjusted balance. I am not going to call the bank and tell them they're wrong. Unless they made a mistake, which is highly unlikely. If there's mistakes, I probably made it. Okay? All right, so let's figure out what we've got. What kind of things might the bank know about that we don't know about? What are real common things to see? Bank charges?
Service charges.
Maybe NSF checks? Somebody give us a bad check? Maybe they collected receivables for us or notes receivable or something. There might be something, right? There might be stuff they know about that we don't know. Okay? Debit memos and credit memos. Debit memos are reducing our balance. Credit memos are increasing our balance, right? They're doing their account. Okay? On our books, what might we know about that they don't know about? Outstanding checks. We would deduct those. Right? We wrote the checks. We took them out of our bank account, but they haven't got to the bank yet. They're outstanding. Got it? Okay, what else might we have? Deposits in transit. Good. We're going to add those, huh? What's that? I took a deposit to the bank or I mailed it to the bank and they haven't recorded it yet. That's all. Okay? No big deal. If it's in the mail, they didn't get it yet either. Okay? All right. So I'm going to subtract these and add those. I would expect to see those things, right? Okay? So let's look at the bank statement. Let's see what the bank knows about that we don't know, what we don't know about. What do you get? What you could do is look for debit memo and credit memo. They didn't do that here, but they put little asterisks next to things for us. That's nice, huh? 2,350 of interest was collected. See that one? What's that? The bank knows about it. I don't. It's not in my account yet. So what do? Interest collected. Do I need to make a journal entry for this? Seeing as I have not recorded it yet? And I have more cash than I thought I did? Sure, so what am I going to do? Whoops, put it in the wrong side. Anybody notice I put it in the wrong place?
Didn't make any sense.
Oh, I put everything in the wrong side. Didn't you guys notice that? Somebody did.
You would add that to yours, right?
I'm going to add it to the balance per bank. I've recorded it, they haven't. Sorry. I put it in the wrong side. I asked you guys if you're tired. Yeah. These are things I already know about. They're already out of my books.
So the one on the right is our books, the one on the left is the bank's. Yeah, the right's our books.
Yeah, yeah. I put the bank. This is us. This is the bank. So the bank doesn't know about the deposits, and the bank doesn't know about the outstanding checks, right? Yes, ma'am.
For the outstanding checks, would you prefer it to just be a blue line or like just a
I don't care. I'm just going to want you to give me the ending balance of the journal entry, really.
Okay.
Right? That's all we really care about. Right? Form's not all that important. It could be anything you want for this. Okay? And different companies use different formats. It's not a report you put externally. Balance sheet, income statement, cash flow statement, all that stuff, they have to be done. Following generally accepted accounting principles. This is just a worksheet, basically. Okay? Good question. All right, but I would suggest you put the deposits in transit out into the bank. Again, take the outstanding checks out of the bank account. Okay, so what we're trying to do is figure out how much the bank thinks we have versus how much we think we have. Get them reconciled. Okay, so let's take this 2,350. It was interest collected.
Yeah.
So we have more than the 2,370 we thought by 2,350. Got it? Will we make a journal entry for that? Sure. You're going to debit cash for 2,350, right? And credit interest revenue if it hasn't been recorded, right? It's interest they collected for us. Got it? But I'm going to wait and make one entry. I'm not going to make a whole bunch from the cash. What for? I'll make one. Okay, after we're done. Okay? All right. And then bank service charge, where does that go? I have not taken it out of my account. The bank has. Service charge. And am I going to make a journal entry? What is it, 120? Am I going to make a journal entry for that? Well, sure I am. Credit cash and debit what? How about miscellaneous expense? Good enough for the small or bank service charge expense. I don't care. Right? To an expense account, though, right? Expensive. Okay? Take it out of cash. So those two we have to do. I don't see anything else listed there. Do they have any NSF checks? Now they have EFT, electronic fund transfer, but did those hit our books? Careful, it's your cash account. There's one for 250 and one for 850. That's all there is, isn't it? They're there. We don't have to worry about those. If they weren't there, I'd investigate. I should know about them because I transferred the funds, right? All right, everybody good? Either that or somebody transferred funds out of my account that I didn't know about. My account. Okay? So you could have electronic fund transfer deposits and withdrawals. Okay? They only have withdrawals. Well, we're done with that then. So what else is there? There's no NSF checks. How do I know that? They didn't list any. They would have listed them. If they had one, they would have taken it out of the bank account, right? What would we have to do? Subtract it from our balance per books and make a journal entry. What would the journal entry be for an NSF check? Credit cash, debit, accounts receivable, huh? They owe me again, right? And there might be some errors we don't know yet, okay? So what do you want to do now? We're looking for deposits in transit and outstanding checks. Well, that's true. We already knew that, okay? What do you do for deposits in transit? It says at the beginning of the month there were none, right? So let's check. So there's nothing that should come in from last month. The first one that comes in should be the first deposit we made. What's the first deposit we made this month, you guys? Look at that problem. What's the first deposit we made? On August 2nd, $11,700. Look at the bank statement. Did it get there? $11,700. The answer is yes, yay. It's recorded the right amount. If it's recorded the wrong amount, we know we have an error. We pick that up, right? So we're just going to match up. Everybody good? They're both in there in the same period. The next one's 4,000 on the 12th. Did that get to the bank? Yeah, it's there. It's the right amount. How about the 24th? Yes, it's there. It's the right amount. How about the 31st? No, it never got there. So what are we going to do? Deposit in transit must be how much? 5,200. And we just got a lot closer between the two balances, right? Now, I'm not going to call the bank and tell them about it. It's going to get there, right? It's on the way. Yes, ma'am, over here.
Does it matter that the 11,000 was is on the bank statement on August 3rd? Even though it says Friday.
Oh, yeah. Could it be a day later? Sure, you mailed it. If there's a weekend, it might be 3 days later. If it's a long time later, I'd investigate that. Does it make sense? Because somebody didn't deposit it, right? Or they recorded it too early on their general ledger. By the way, later, if you become an accounting major and you're in accounting 418 and we're doing auditing and we're looking at cash, you check those dates because people will cheat. They'll pretend they received money this month when they really received it next month. They'll record it on their books this month so it looks like they have more cash, even though they didn't receive it till next month. And you can find that by looking at the dates, okay? They're trying to cheat in their financial statements, intentionally misstating their statements. Yes?
I get where you got the interest collected, but where did you get the deposit in transit?
Oh, in the general ledger, in the cash account, the T account, that represents the general ledger, right, where we're recording things. We recorded on December 31st, 5,200.
Okay.
It didn't get to the bank. The other ones all got to the bank. The other three all made it there. And of course, there'd be a deposit every day, right?
Yeah.
So it'd be probably one deposit a day, although you might have 1,000 bank accounts in a big company, but still, it's the same thing for each bank account.
Since there's a deposit, that's why it's a deposit in transit, not an outstanding check.
You got it?
Yeah.
Yeah. And if it got to the bank, there is no deposit transfer, right?
But for the check, it would be an outstanding check.
You got it. So now what we're going to do is we're going to look for checks that didn't clear, right? What I mean by clear is that it's on your books and it's on the bank too, huh? Cleared the bank, okay? Because obviously you know about your deposits and your checks before the bank does. You did them, right? You wrote the check. You sent the deposit. Okay, so anyway, so let's look at the checks. It said how many were outstanding? There's one for $270, right? 270, 430, and 320. They didn't give us numbers, but see that down there at the bottom? Okay. So did the one for 270 get to the bank? Yeah. And if it had not, what would we think? It's still outstanding. Right? If it was still outstanding, what would we do? Put it on our bank reconciliation. It's still outstanding. And investigate if it's been 2 months, right?
And then when we take that off or subtract it from our balance. Like if it's outstanding.
Yeah, if it's outstanding, we subtract from the bank balance.
Yeah.
Or, yeah, we're still outstanding. Because the bank wouldn't know that. Yeah. Okay? Yes. How about the 430? Did that one get there? Yes. How about the 320? Did it get there? Yeah. So all of them cleared, which is pretty standard, right? They get there. Okay? Make sense? So now what do we want to do? I would put a little mark next to those in your book there, so we don't mess with them again. The 320 got there. The 320, the 430, and the 270. The first three there, right? They're fine, aren't they? They cleared from last month. Now let's check this month. What cleared this month? Let's see, there's one for 880. That's the 880 on our books, right? There's an electronic fund transfer for 250. That got there, didn't it? How about the 350? Yeah, it got there. It took a while, but it got, well, maybe, no, it didn't. It was only one day. It got there too, didn't it? How about the 20,400? Yeah, it got there. How about the 850? It got there. Did they all get there?
No.
Oh, that's all of them that got there, but what else? So let's see. What did not get there? Okay. The 280 on the 15th and the 510 on the 17th did not get there. So what do we have for outstanding checks? Yeah. Number and number. We don't know the numbers, but we really, in real life, write it down. Okay? So the one from the 15th was 280. Excellent. The one from the 17th is 510. We add the two together, and what do we get? 790. And now you pray. What do we want to have happen?
Equation.
Yeah. So say a little prayer first, right? Yeah. 190 plus 5200 less 790 is how much? This plus this less that. What?
22,600.
Are you using a calculator? Ah, see another one. Smart ass in the front, one in the back, okay? What's 20,370 plus 2350 less 120? I could probably even do that in my head if I stopped
No,
talking.
we did it in that computer system.
Oh, cool. All right. She already had the answer. What's that one? Is it 22.6?
Equal to same.
And what do we want? For those numbers to be the same. It's called reconciling, right? We reconcile the bank. Ta-da! But we need a journal entry. Don't leave yet. Do a journal entry and then we're leaving. You guys have to pay me overtime. Okay, here we go. Bounty count.
I got a haircut.
I'm the most inefficient person ever teaching. Okay. Need a lot of time. What do we need to do here? How much happened to... By the way, whose books are we adjusting? The bank's or ours? Ours. The bank is fine. Those are outstanding checks, the deposits in transit. We're adjusting ours. How much more do you want to have in the cash account? I don't want it to be 20,370. What do I want it to be? 22.6. How much do you need to debit it for? 2,230? Yeah. Debit cash, 2,230. I was just showing off that I could actually do something like that. Okay, then what else do we need to do? Interest collected is interest what? I collected interest, you guys. Somebody paid me interest.
Interest revenue.
Interest revenue, unless they have already accrued it by debiting interest receivable and crediting interest revenue. And if it had been accrued, did it say in the problem? It doesn't say that.
Yeah.
Okay, if it had been accrued, it'd be interest receivable.
Okay.
If it has not, it's interest revenue. I would assume that it's interest revenue if they don't say anything. And now I need a debit for how much? 120, of course, which is service charge. What do you want to call it? Miscellaneous expense or service charge expense. And you know what? We're done. Bank reconciliations are easy. I told them at this meeting I went to yesterday that a whole bunch of my students had bank accounts. They'd never done a reconciliation. 4 of the people sitting at the table were bankers. And they're just like, oh my God. And I says, and these are the business majors, you guys.
How are you only supposed to do
Because they were asking, do college students really not know how to do banking? Really? Yeah.
Aren't you only supposed to do it if you write checks up?
Oh, if you don't write, well, I would do it if I had a debit card too.
I have a debit card, but I haven't written a check.
Do you ever deposit and withdraw?
Yeah.
Do a bank reconciliation?
Yeah.
Yeah, I would.
Most times.
Yeah.
That just
Yeah.
seems like a flawless thing though. It's like the debit card, everything happens. Well, we think it.
You would think so.
As long as you don't have a credit card.
Yeah, you would think so. You would think so. There are mistakes happen in the world. It's your money. You're right though. It's not as big a deal. But